The Persian Gulf is facing one of the most dangerous moments in recent history. The fighting has already disrupted oil routes. But the latest news is even more serious. Desalination plants in the Gulf have been hit, and these plants are the main source of drinking water for most Arab Gulf countries. When desalination is threatened, it is no longer just an economic issue, it becomes a survival issue. This raises the stakes of the conflict, and increases the fear that things could get much worse. When oil depots burn, when tankers change their routes, and when water supplies are at risk, the shock spreads far beyond the Middle East. Fuel becomes more expensive, transport becomes more expensive, food becomes more expensive, everyday life becomes more expensive. This is how a war in one of the most sensitive regions in the world reaches into the pockets of ordinary people everywhere. Just like it did during the oil crisis of the 1970s and the Gulf War in 1990. Markets react to this kind of fear in a predictable way. Investors sell because they do not know how long the trouble will last. Mining companies fall because their fuel costs rise. Banks fall because people worry about a slowdown. Technology companies like QQQ in the United States or NDQ in Australia fall because higher interest rates make it harder for them to grow. Even gold miners fall because they depend on diesel and heavy machinery. Fear spreads quickly. And when fear spreads, markets fall together, but gold behaves differently. Gold does not depend on fuel or interest rates, or company profits. Gold is where people put their money when the world feels unsafe. That is why gold often rises during wars, inflation shocks, and moments of uncertainty. It becomes a financial shelter, just as it did during the 1979 Iranian Revolution, and during the 2008 financial crisis. Gold metal can stay strong, even when everything else is falling. Based on past crises and how markets behave, there are three possible paths from here. The base case is a contained disruption lasting 4 to 8 weeks, with the Strait of Hormuz partly open. In this outcome, the world faces a logistical shock, but not a full collapse. Brent oil stays around $70 to $85. Markets stay nervous, but pressure slowly eases and gold cools as confidence returns. The bear case is a prolonged disruption lasting 2 to 6 months. In this outcome, the world faces a real supply shock. Brent oil moves into a higher range, and volatility keeps spiking as new headlines hit. Gold often becomes a long-term hedge in this environment because people worry about inflation, slower growth. The bull case is a sudden ceasefire within 4 weeks. If that happens, Brent oil could fall back to pre-war levels quickly. Markets would breathe again. Confidence would return, and gold would cool, but remain supported by the memory of how fast things can change. For investors, the goal is not to guess which outcome will happen. The goal is to stay calm and understand that gold can help protect a portfolio during times like this because it does not depend on the same things that make other investments fall. Gold can act as a stabilizer while you wait for the world to move from fear back towards stability. History shows that after every crisis, there is a new phase of rebuilding and opportunity. Prices fall, then they stabilize, then they rise again. Investors who stay patient and disciplined usually benefit the most. This is not financial advice. Always do your own research. And if you want to stay ahead of the chaos, make sure you hit the subscribe button.